The equity market, also known as the stock market, is like a giant marketplace. Here, companies list their shares for investors to buy and sell. Think of shares as small pieces of ownership in a company. When you buy shares, you become a shareholder, owning a tiny part of that business. There are two main types of markets within the equity market, primary and secondary. The primary market is where companies first issue shares to the public through an initial public offering, or IPO. Imagine a bakery selling its freshly baked cookies directly to customers. That's the primary market. Once these shares are bought in the IPO, they can be traded among investors in the secondary market. This is similar to customers reselling the bakery's cookies amongst themselves. The stock exchanges, like the Bombay Stock Exchange and National Stock Exchange, act as platforms for these trades. In essence, the equity market provides a mechanism for companies to raise capital by selling ownership stakes and for investors to participate in the potential growth of these companies. Companies go public through IPOs for several reasons. Primarily, it's a way to raise large amounts of capital for expansion, research and development, or paying off debts. It's like getting a big loan from the public, but instead of paying interest, companies give away a part of their ownership. When a company decides to go public, it sets an initial price for its shares. This price is influenced by factors like the company's financial performance, industry outlook, and market conditions. Investors then subscribe to these shares, hoping to profit as the company grows and the share price increases. The IPO marks the beginning of a company's journey in the stock market. From this point onward, its share price fluctuates based on various factors, and investors continuously trade these shares in the secondary market. Investing in the equity market can be rewarding in two primary ways: dividends and capital gains. Dividends are like a share of the company's profits distributed among its shareholders. If the company performs well and makes a profit, it may choose to distribute a portion of this profit as dividends to its shareholders. Capital gains, on the other hand, occur when you sell your shares at a price higher than what you initially paid. For instance, if you bought a share for 100 rupees, and later sold it for 150 rupees, you'd make a capital gain of 50 rupees. However, it's crucial to remember that the equity market is inherently unpredictable. While the potential for gains exists, so does the risk of losses. If a company doesn't perform well or market conditions are unfavorable, share prices can fall, leading to capital losses if you sell. Several factors can cause stock prices to fluctuate. Company performance plays a significant role, with positive news often leading to price increases and negative news causing declines. Market sentiment, essentially the overall mood of investors, also impacts share prices. A bullish sentiment can drive prices up, while a bearish sentiment can pull them down. Additionally, macroeconomic factors like interest rates, inflation, and economic growth influence the performance of the overall market, impacting individual stock prices. It's like a ripple effect where broader economic conditions influence investor behavior and consequently stock valuations. Numerous players participate in the equity market, including individual investors, institutional investors like mutual funds and pension funds, and companies themselves. Each participant has unique investment goals, risk tolerance, and investment strategies. In conclusion, the equity market, while complex, presents a potentially lucrative avenue for individuals to participate in the growth of businesses. By understanding the basics of how the market works, the factors influencing stock prices, and the inherent risks involved, investors can make more informed decisions. Remember, knowledge is key when navigating the dynamic world of equity investments.